you love ETF investing as much as I do, then this video is for you. Because of the years of investing into the S&P 500 ETF, my ETF of choice with Vanguard, I think it's time for me now to make a change to this, because in this video, I'm going to share with you the cheapest S&P 500 ETF in Europe. And in the end of the video, I'm going to show you some calculations to show you how much you will be actually saving by changing from Vanguard or even BlackRock to that new ETF. And as you can see, the new ETF is provided by State Street. They're offering Europe's cheapest S&P 500 after a major fee cut. Previously, they used to be much more expensive. Now, if State Street doesn't ring a bell for you, don't worry, you're going to be in safe hand, because as a matter of fact, it's the world's third largest ETF issuer based on US equities. That's just after BlackRock and Vanguard. So a really trusted name in the industry, in the field of ETFs. I'm not promoting anything fishy or scammy. I really only go with trusted players in the industry, and State Street is certainly one of them. And previously, I never considered them because their fees on the S&P 500 was 0.09%, which again is not that high. You know, some other big global ETFs, they charge 0.22, even more. So 0.09 is still not bad. But on my Vanguard, I paid only 0.07, but now since the 1st of November, they dropped it to only 0.03%. I mean, that's next to nothing, literally. I'll show you, as I said in the end, how much you'll be saving by going with that option. That really makes it so much more attractive in my eyes. And I can only imagine that this will attract way more new investors to that ETF as opposed to some more expensive ETFs. Now, a quick recap on expense ratios of ETFs. That's basically the management fee that you as the investor would be paying the company for managing your stocks within that ETF. The ETF is based on an index, and the index changes over time, and they try to replicate that index by buying different shares, right? If one company becomes more valuable, they would then have to rebalance their portfolio, buy more of one stock, sell some of the other, just to balance it out to be in line with the index, in this case the S&P 500. And of course, those companies are profit companies. They don't do this for charity or fun, so they have to make money for their investors in the process. So it's only normal and fair that they charge you a fee. And those fees are traditionally way better than some mutual funds would charge you, or some local banks for managing some random fund you never heard about. I mean, I've seen people paying in the local banks up to 1.5%. That's crazy. Imagine you make a 6% return, 1.5%. Now you only make 4.5%. So when we talk about ETF expense ratios, traditionally, they're already way better than so many other financial products out there, because typically they're so competitive. There's so many players in the niche that the prices come down. We've seen this recently with Bitcoin ETFs. The first one from Grayscale, I believe they charged 1.5% on a Bitcoin ETF. Now new players entered the space, such as BlackRock once again. I mean, is there any space where BlackRock is not involved? They run the world, so to say. So they actually in the beginning waived all their fees just to get more people in. Eventually they're going to charge some fees, but it's going to be very little, so they attract and get more market share. The same is true for share ETFs, and they're obviously competing on these prices, because in the end the performance for most of these ETFs is pretty much the same, right? They're buying the same shares, they're following an index, so there can't really be much difference. The main difference is the name that you're buying, the ETF provider, and here you really want to have a trusted one to make sure they're also going to be around in 10, 20, 30 years from now. And of course, the expense ratio. So as I said, anything under 0.1 is actually really good. Of course, if you buy directly in the US, they traditionally tend to be even lower. Most of them are 0.03%. But unfortunately, in Europe, we have to buy UCITS ETFs, which are registered in Europe, and traditionally they tend to be a little bit more expensive. Now that fee is not actually paid by you, it's just taken out of your profits, so to say. So you never have to make a transfer to them. They immediately take it out from your return. So you actually just get slightly lower return, your normal return minus their fee technically. So there's nothing for you to worry about or to pay or anything. They manage everything. That's just something to keep in mind. So let's have a look how this new ETF actually looks like. So here we have it. Basically, I look up on Just ETF, which by the way is an amazing resource that I can only recommend. You can look for any ETF here and you get some great insights. So I really like that website. So obviously that's the full name, SPDR. S&P 500 UCITS ETF. These are the various technical numbers. Sometimes it's a little bit confusing because there can be so many different places where you can buy them, the currency and so on. We'll come to this in a second. And here you can see obviously the TER ratio, they call it, total expense ratio. These are the costs automatically retained by the ETF provider and are already included into the price and performance of the ETF. So as I said, it's just something to keep in mind. It's nice that it's showed, so it's transparent. Then it's also important what you want. You want a distributing ETF or accumulating ETF. Now here we're looking at a distributing ETF, which basically means any dividends that the ETF produces or would have to pay it's actually paid out to you. There's also an accumulating one, I'll show you in a second, that basically directly reinvested. So it's up to you. I always say there's no right or wrong. It depends which country you're living in, because some countries, they have some advantages if it's automatically reinvested, and they would tax you if you pay it out. Some countries don't differentiate. They're still going to charge you tax even if it's automatically reinvested. So it's really up to you. I usually like to get a dividend because that way it's nice psychologically. You see some money coming into your account, and anyways, automatically I reinvest it together with my weekly stock buys, right? So it's up to you, but I just like distributing. Then we have replication, which is nice. It's full replication. Basically, it means they're actually buying the shares. Also, it's another term for physical replication, because some ETFs, they have a synthetic replication. Basically, it becomes really complicated, but actually, they're not really owning all these shares. So in case things don't go as planned, you might really be into trouble. So that's why I always prefer having an ETF that's fully replicated or physically replicated, meaning that they actually hold the underlying assets in the form of shares. And then you see the fund size. And I think that's also important to look at. Obviously, you want to have a certain fund size. If the fund size is only a couple of 100,000, in case you want to buy or sell something, there might not be enough liquidity in there. So you want to have a big enough fund that there's enough liquidity in there. And also, if the size is too small, eventually the ETF provider might close it down, right? And you don't want to be in that situation. So you want to have a fund that is in a decent size. As you can see over here, one of the bigger ones in Europe. And I believe, as I said before, now with the lower price, will definitely attract more people in the future. So I think the fund size will only go up in the future. Holdings pretty much is the same across all of them because they are based on the S&P 500. Essentially, more or less all of them are pretty much replicating the same shares. And yeah, from here you can basically go down, get a bit more insights, what descriptions are, the chart over time. But once again, these are similar to Vanguard, BlackRock. Basically, they all replicate the S&P 500, so there shouldn't be really much deviation between them. You see here the dividend distribution policy. That's obviously distributed quarterly, but that's also, again, no difference between any of the ETF providers because that's based on the S&P 500. They paid out on a quarterly basis, and then in this case, State Street will just pay you out if it's distributing. If it's accumulating, it will be automatically reinvested on your behalf. The fund is domiciled in Ireland. That's why it's the UCITS compliant in order for Europeans and non-US citizens to buy. That's the only condition there is. Otherwise, we can't directly buy the VOO, for example, based in the US. But now, actually, we don't have a need anymore because you have the same expense ratio, 0.03. That's always what I was jealously looking at, the VOO from Vanguard directly in the US. But now you get it even here in Ireland at 0.03%. So that's really appealing. And then we come to the holdings over here. By the way, you can also just navigate here at the top right away if you want to see that. And you can see here basically the top 10 holdings, which currently obviously is Microsoft. They're really pulling apart. I mean, not so long ago, Apple was the biggest one, but they have been a bit on a downward trend recently. But yeah, that's also weighted, right? So the more valuable, the higher the market cap of a company is, the more weighting it has. That's why you see here in the top 500, Microsoft alone makes 7.26% of the portfolio. And the 10th biggest company right now, Tesla, only 1.27. So imagine the 500th biggest company in the portfolio probably makes up 0.01%, for example, right? So in the end, we invest into 500 companies, but essentially really, you can see here, the top 10 alone make up 31%. So that's actually what you're investing in. But again, the beauty with ETFs, we don't have to care who's in the top 10, right? Even if Tesla drops out big time, even Microsoft goes to 11th place, but then another company comes to the first spot. It's all done for you. Basically, State Street does all that management, buying, selling, and readjusting on your behalf. And all you have to do is pay them 0.03% of your return. So I think it's really a fair deal and something why I like ETF investing, and going forward, I probably want to get back more into it. You see here also the sectors that they invested in, but once again, that's based on the S&P. So that's the same across any of the different ETF providers. You see here the dividends that they're paying right now. Again, same for all the different ETF providers on that particular ETF. And then we come to the stock exchanges where they actually listed. And I think that's really very helpful because a lot of you are living in different countries. So you can see what works best for you, because you can buy that ETF, you can see it in so many different places. You see, you can buy in Germany, in Italy, in France, in London, in Switzerland, in Germany once again, and all of them have different names and different currencies. So always think about which currency you mostly transact in, and I think that's the best way to buy it in the local currency, because there's no point every time to switch the currency unless you really wanted to. But otherwise, if you're in the UK and want to invest in pounds, then go for the pounds. Don't convert it to euro and invest into the same index based in Germany, right? And vice versa. If you're living in Italy, then buy in euros in Italy, right? Myself, as I said, I used to buy the Vanguard VUSA ETF and I bought it in Amsterdam in Europe. It just worked for me. Right now, looking at this, most likely I would buy in Italy or in Germany, because I know that in Paris and France, there is a bit of a withholding tax, I believe. So the dividends, I would have to pay slightly higher withholding tax on that. So also think about that, what works best for you. So depending on where you live, do a bit of research, which is the best stock market to buy at. But first, I would start looking at the currency you want to buy in and then narrow down with stock market and then see which makes the most sense from a taxation point of view and then just go for it. Now, as I mentioned before, they also, of course, have the same ETF, but instead of distributing, they have it accumulating. So instead of receiving the dividends, they basically automatically reinvest and buy more shares on your behalf. And the great thing is still the same low expense ratio of only 0.03%. And yeah, the rest is pretty much identical. You can see the fund size is a little bit less, 2.7. The other one was 8 point something. So usually that tends to be the case. More people tend to go for distributing. Doesn't mean it's better. It's just what resonates with more people because they like to get the dividend and maybe one day live off the dividend. So it's nice to receive it. But in the end, it has to work for you. As I said, it's still a very high fund size actually. So really nothing to worry about. Either one of them will be a great option. And of course, once again, you can go down to the stock exchange list and you see here where they are listed. For example, the distributing one apparently wasn't listed in Amsterdam, but this one is actually listed in Euronext Amsterdam. So yeah, really interesting. I like buying in Amsterdam. I've just done it for many years. It works for me. But yeah, really a great overview to see where you can buy the specific instrument that you're looking for. So just to show you also the other ETFs based on the S&P 500 and how much they are charging, to give you an idea how low that actually is. So here we can see once again just ETFs, the top S&P 500 ETFs. I really love that website in general. For ETFs, it's one of the best resources I found there. So you can see here the best S&P 500 ETFs by returns that is. You can see they're pretty much all the same. Then the largest ETFs, that's by fund size. You can see how big the biggest is, 75. We saw at 8. So really comparatively, definitely not too small either. And then we look for the cheapest S&P 500, which this video is all about, obviously. So let's click into this. And then you see here all 23, currently we have 23 S&P 500 UCITS ETFs in Europe, basically, that you can buy. And what do we see? Of course, the first two, as we just went through, are the newly revised State Street S&P 500 UCITS ETFs. And as you've seen, the one with bigger market size, 8.1, is the distributing one, followed by the same, just accumulating with 2.7. But then, just for fun, let's go down the list and see some other ETFs and their expense ratios. We have Invesco, another big player in the ETF space at 0.05, which is still better than the one I have right now, but still 0.02% higher than the one we just spoke about. Then again, iShares from BlackRock, also very competitive. Then we have Xtrackers, Amundi, and when do we have the one I'm investing in? Just over here, Vanguard S&P 500, that's the VUSA one, 0.07%. But at the same time, you see here a major volume, right? We have iShares, by the way, I skipped that one. That's from BlackRock. It has the same expense ratio as Vanguard. So the two biggest ETF providers in the world, they're really going neck to neck here. So you can see, and both of them having major inflows into their ETF on the S&P 500, despite their fees being slightly higher. But I think with those changes to 0.03, we reached a new threshold because, from 0.07 to 0.06 or 5, maybe you wouldn't be too convinced to change it. But now it's less than half the expenses. I think some people might really reconsider. But of course, if you further go down the list, the highest in this case at 0.15%. So that's 5 times the fees of the cheapest one. Even though, having said that, that's actually still way cheaper than many other ETFs I've seen from local banks or other ETFs, global ETFs, the popular Vanguard FTSE All World. I mean, this one has an expense ratio of 0.22%. Now, of course, there are way more holdings in here. You can see 3,643. So understand that there's more management behind it. It's a global ETF, so I get it. But we definitely have to consider expense ratio when calculating our total returns, and that will make a difference. Now, what kind of difference? Let's have a look. Just ETF has actually a great ETF cost calculator to see the difference by having different expense ratio across different ETFs. So let's take this example over here, input value. In this case, let's start with 20,000. Obviously, the bigger the value is, the bigger the difference. But I think 20,000 seems like a reasonable amount. For some, it's very little. For others, it might be a lot. But long term, I think that might be a number a lot of people could get or feel comfortable with. Investment horizon, let's put 30 years. This channel is all about long-term investing. I'm not a day trader, and I'm not talking about 2 or 3 years. An ETF for me is really set it and forget it. This is your potential retirement plan one day. So really we want to have a long-term outlook. For some of you, it might be even 50 years, right? But once again, let's take 30 years. as some kind of average. And then of course, annual return in percentage, let's have 8%. You know, S&P 500 over the last 30 years returned anywhere from 8 to 10%, but I believe 8% is fairly realistic. Right, so then we go down to the costs over here. We input the various transaction fees. Now transaction fees, let's leave it at 0%, and then management fees, so this is the expense ratio, let's put 0.07% and 0.07%. This is what I'm paying right now. A lot of you investing also into the VUSA, S&P 500, Vanguard ETF. So in this case, it would be 0.07%. So yeah, so basically if both of them are the same, you can see here after 30 years, your portfolio would grow to 201,000. The total cost that you pay, well, you don't really directly pay, but it's basically deducted from your returns, will be 3,800. This is the fees that you pay over the 30 years to, in this case, Vanguard. So after deducting the fees, you would have a total portfolio value of 197,000. So pretty straightforward, makes sense. And yeah, really not too bad when you think about it over 30 years, the fees quite reasonable. But now let's go ahead and change it and assume the other ETF in this case would not be 0.07, but actually only 0.03. Now, all of a sudden you see here, the cost is less than half than you had with the Vanguard one, right? Now it's only 1,600 the cost. Previously, it was 3,800. So that's quite a difference when you think about it, right? Even though the percentage seems very small, in the end, it is actually quite big saving, right? And in this example, obviously, I didn't assume that we will make additional investments over the 30 years. So that's why it's 20,000. The difference won't be so big. Let's say for the sake of it, you keep on investing and we have a bigger investment value. Let's say 100,000. Now all of a sudden, you will start seeing a major difference. Instead of spending 19,300 on fees, you would spend way less, only 8,300. So here, if you ask me, that's a major difference. With that money, you could really go on a nice holiday or buy yourself something nice or reinvest into the markets. So honestly, that's why I'm so passionate about reducing your fees. And like I said, even 0.07 is still good. Let's go back to the example I just shown you before of the Vanguard FTSE All World ETF, which had 0.22% expense ratio. Calculate that. And now you will see a huge difference. Instead of paying 59,000, still you would only pay 8,300. So that ETF has to really outperform and do much better in order to justify the way higher expenses. So when people ask me, why you don't invest into global ETFs and have many different ETFs, because I'm very conscious of keeping my expense ratio low. And honestly, with this one of 0.03%, I think it's impossible to beat. I mean, where do you go from that, right? Because they're still going to have to make some kind of money. So I think it's really attractively priced and very appealing to a lot of investors. So let me show you where you can actually buy that ETF. For example, Interactive Brokers, which is my broker of choice, where I buy most of my stocks. Just go ahead and copy paste the ticker symbol from just ETF into here. So let's go ahead and you will see here the number of places where I could buy it. Now, in the beginning, as I said, that's why always Interactive Brokers is a little bit overwhelming for some, because you can see here abbreviations. IBIS2 may not mean much to you. It's basically in Frankfurt. Then we have LSEE, that's in London. Obviously, you have different currency. Then you also have EBS. And in case you don't know what it is, you can just click into it and it will open up. And you see here right away actually the little flag. That's the easiest way to tell. EBS is actually based in Switzerland. And then of course I can see the currency, in this case francs. But of course if I go back and look for it again, I could see the second EBS ticker and that would open up again Switzerland, but in this case USD. So just play around a little bit. That's why I said go first on just ETF to understand where you want to buy. It makes things easier to understand which one you want to buy eventually. And of course you could also do the same on another one of my favorite brokers, which is Trading 212. Love the interface. Normally I buy everything through the app, but for the sake of the example, you can also log in to the web portal and then same story over here. Just click on search, put the ticker symbol over here. And already I like it much more. It's a bit cleaner and easier to see. Still, you have to play around a little bit where certain things are located, but you see already at least the currencies. I can see dollar, euros, pounds. So I can already rule out certain places that I don't want to invest in. So let's say I want to invest into euro, of course. I want distributing. So, there are not too many options out there. So basically that's most likely going to be the one. Let's click into this. It pulls it up and I can see here right away most of the information. Of course, it's in Europe, it's distributing. Okay, where is it located? If I scroll down, instrument details, that's very important to look for. And I can see it's based in Germany, Deutsche Börse in Frankfurt most likely. And yeah, if I'm happy, I can go ahead and start buying that. So there you have it. If you already invested into some S&P 500 ETF in Europe, then honestly, I think it's a good time to reconsider your choices. Play around with the calculator, run your own numbers, but you see, the larger the amounts gets, the bigger the difference in terms of fee will be eventually. So in my case, I'm really getting attracted by that. And I honestly think very soon I'm going to be switching from Vanguard to State Street. And I think more people will follow. And that's going to be good for the liquidity and the size of the fund. So yeah, I'm really excited. 0.03%, that's unbeatable. But I'm excited to hear from you. What are you planning to do? Stick with Vanguard or BlackRock? or try out State Street to save on the fees? Let me know down in the comments below. Always happy to hear from you. If you made it until the end of the video, I have two things for you. First of all, thank you for staying for so long. I really appreciate it. And second of all, congratulations to you, because you seem to be on the right path of taking investing really serious and leveling up your money game. Next up, check out this video here. As always, stay healthy, get wealthy, and I'll see you in the next one. Ciao.